Hi, this is Doug Brennicky. Many times when a borrower starts the loan process, we'll make a reference to the underwriting of the loan. And borrowers many times will be a little bit confused about what underwriting involves. The easiest way for me to explain it is that there's basically what I have learned is the 4 C's of the underwriting process: cash, capacity, credit, and collateral. And let me briefly describe those 4 things because they're the basics of what an underwriter looks at for a file. There's a lot of little trails that we can take off of that because every person's borrowing profile is a little bit different. They've experienced different things in their life that we have to maybe prove for the file and to get letters of explanation or to ascertain. But all four of these categories pretty much define the underwriting approach. Let's talk about cash for starters. If you're purchasing a home, this would be to verify that the borrower has enough cash for the down payment, closing costs, and cash reserves after closing. Lenders don't want to see that you're borrowing that money in addition to the money that you're asking for on the new loan. And they want to make sure that you're not just squeezing your last couple dollars to get into the home and you have no cash reserves after the transaction is finalized. That's not a healthy lending situation. If you're refinancing, the term cash, in a sense, is maybe more the equity that you have in the home. That the difference between the value of the home and the amount of the loan that you're asking for gives a cushion or some feeling of comfort to the lender that they're not making a very high-risk loan because of the equity position in the property. The next one is capacity. This one goes to the question of employment and income stability. The lender always wants to make sure that your employment history is pretty solid. And by that, the typical industry standard is a minimum of about 2 years in the same position or line of work, or if self-employed, 2 years running your business. The capacity portion as far as income comes in from the standpoint making sure that your income that you're earning, whether it be from wages or salary at a job, or from the net business income from your self-employment, is large enough for you to be able to comfortably handle the mortgage payment, the property taxes, the insurance, maybe homeowners association fees on the new home, or the new home loan I should say, and in addition to any other obligations that you have, whether it be car loans or personal loans or extended credit card payments, or possibly alimony or child support, or some other contractual obligation that you have. The lender wants to make sure that you're not squeezing it really tightly every month to try to make all of those obligations fit within your income. The next one is credit. This is taking a look at your credit history and also monitoring what your credit scores are. Credit scores have come into vogue as far as being some kind of predictive model for being able to ascertain whether a borrower who is applying for a credit is in fact somebody who has handled their credit well in the past and would most likely be able to continue it in the future. So the lender takes a look at the credit history, the amount of obligations that are showing on the credit report, and making sure that it looks like a healthy credit situation and that somebody doesn't overly use or abuse their credit privileges. And then lastly, the final C is collateral, and this is the property itself. On a purchase or a refinance, we always need to get an appraisal done to ascertain the value of the property, and in some ways to check out what the condition of the property is as well. If there's health and safety issues, those kinds of things will need to be corrected before the transaction can close. But mostly the lender is interested in making sure that the value is pretty solid, and that if they ever needed to take that property back through a foreclosure action, that the lender would be able to market it pretty quickly, and that they're not lending a very high amount of loan against a property whose value maybe has been overinflated, and then they're left out there with a very risky loan if they ever had to take it back. So hopefully you can see that the 4 C's, cash, capacity, credit, and collateral, are pretty essential elements, but there's a lot of little details that go into all that because everybody's situation is different. So thank you very much, and we'll be on to another lesson shortly.